All right, today we're jumping into a fantastic lesson from the absolute legend of value investing, Benjamin Graham. We're going to uncover a powerful and, honestly, a pretty counterintuitive truth about how the stock market really works.
So let's start with a wild thought. What if the companies that kind of put you to sleep, the ones making work clothes or delivering food to cafeterias, what if those were actually better investments than the flashy, high-flying tech companies that everybody's talking about? It's a weird idea, I know, but stick with me, because it might just change how you look at everything.
So here's how we're going to do this. Graham had this absolutely brilliant way of teaching. Instead of just rattling off a bunch of boring principles, he would set up these head-to-head showdowns, almost like a financial boxing match between two totally different companies. And it's the perfect way to really see the difference between speculative hype and, actual real business value.
Okay, our first matchup is a classic Tortoise versus the Hare story, straight out of the 1960s. In one corner, you've got the real estate investment trust. Just think prudent, stable, been around for almost 100 years, and it's been paying out dividends like clockwork. That's our Tortoise. And in the other corner, Reality Equities Corp. This was the Hare, this flashy, go-go venture that just exploded out of nowhere, expanding recklessly into all sorts of things, racetracks, cosmetics, you name it.
Now here's where things get really interesting. This is how Wall Street actually saw these two companies. You'd think the stable, profitable one would be worth more, right? Nope, not even close. Back in '68, the market valued the reckless, debt-drowned realty equities at $105 million. That's nearly 3 times more than the prudent trust. I mean, just look at that debt difference. And then you have the book value per share, which is basically what the company's stuff is actually worth. It was a solid $20 for the trust versus a measly $3.41 for realty equities.
And this, right here, is the craziest part. At its peak, Realty Equity stock was trading for more than 10 times what its actual physical assets were worth. The market was completely hypnotized by the story of growth, and it just totally ignored the incredibly shaky ground it was all built on.
Well, you can probably guess what happened next. Financial gravity, it always wins. The prudent trust, it just kept chugging along, doing its thing, making money. Realty equities, on the other hand, it collapsed spectacularly. Its value was completely wiped out, and they even had to suspend trading of its shares. The Hare just totally ran out of gas.
Okay, let's look at another classic fight to see this same pattern play out. This time we've got H&R Block, the tax prep company. Its rise was, and I'm quoting Graham here, meteoric. The market was ecstatic about it, and its opponent, Blue Bell, a company that made work clothes, a company that, as Graham put it, came up the hard way. You see the pattern, right? It's another classic Hare versus the Tortoise.
And this is where the numbers just get absurd. In 1969, Blue Bell had almost 4 times the sales of H&R Block and was actually making more profit. But look at the PE ratios. That's the price the market is willing to pay for $1 of profit. People were willing to pay 108 times earnings for H&R Block, while Blue Bell was sitting at a totally reasonable 11. It makes no sense. The result? The smaller, less profitable company was valued at over 3 times the bigger, more profitable one.
So what is Graham really trying to teach us here? It all boils down to this, the huge critical difference between price and value. See, price is what you pay. It's driven by popularity, by emotion, by hype. But value is what you get. It's the real underlying business with its assets, its earnings, and its actual financial strength. And an intelligent investor never, ever confuses the two.
Graham nailed this idea with his most famous quote ever. In the short run, the market is just a popularity contest. It's a voting machine. Whatever's popular gets the votes. But eventually, it becomes a weighing machine. Because sooner or later, a business has to be judged on its actual ability to make money, on its financial weight, not just its popularity. The votes always fade, but the weight, that's real.
Okay, but you might be thinking, sure, that was the 1960s. Does any of this still apply in the modern world? Well, to test it, let's fast forward about 30 years to one of the biggest speculative bubbles in all of history, the dot-com bubble. And what do you think we find? Well, history doesn't exactly repeat itself, but wow, it sure does rhyme. Our modern Hare is Cisco Systems, the absolute darling of the internet boom, which for a little while was the most valuable company in the world. And our Tortoise? Cisco Corp, a super unglamorous company that supplies food to restaurants and hospitals. The parallels here are they're striking.
Okay, get ready for this, because this slide is just stunning. At the absolute peak of the bubble in March of 2000, Cisco, the boring food supplier, actually had higher revenues than Cisco, the tech giant. But the market's voting machine was in complete overdrive. It valued Cisco at $548 billion. That's almost 50 times more than Cisco. The hype about the future was just completely drowning out the reality of the present.
And if you want just one single number to capture the sheer insanity of this time, look no further than another dot-com Hare, Yahoo. In late 1999, its stock was trading at a price-to-earnings ratio of over 3,000. Investors were literally paying more than $3,000 for every single dollar of that company's profit. It's just mind-boggling. So what happened when the voting finally stopped and the weighing began? Well, it's exactly what Graham would have told you was going to happen. As you can see right here, between 2000 and 2002, the Hares, companies like Cisco and Yahoo, they collapsed. Meanwhile, the boring Tortoises, like Cisco, they just kept chugging along, delivering solid, positive returns for their investors. The weighing machine, it always wins in the end.
So how do we actually use this? Graham gives us a really clear framework. First, you have to question the hype. Always, always look past the exciting story to the cold, hard numbers. Second, focus on valuing the actual business, not just reacting to the wiggles of the stock price. Third, demand a margin of safety. That just means you only buy when there's a big gap between the price and what you think it's really worth. And finally, be patient. You have to let the weighing machine do its work. And that's really the ultimate takeaway here. This whole thing isn't about trying to predict what the market will do next week or next month. It's about having a durable, time-tested way of thinking that helps you make sound judgments and helps you separate real investment from pure speculation no matter what the crazy headlines are saying.
Which, of course, brings us to right now. When you look at the market today, with all of its new trends and super popular stocks, just ask yourself, who's the tortoise, quietly building real value? And who's the hare, just running on pure hype? The answer to that question could make all the difference.